Cloud recording storage. What's the message? What's the meaning of this? Can you help? You see that message, Kim?
Which message? We don't see anything.
No. See, actually, I saw a message saying cloud storage is full, and then recording could be difficult. Is it for my device personally, or is it for the Zoom account, or?
Hello? हो गया?
Yeah.
Jean, are you with us?
Jean, I'm talking to you.
Yes, Mr. Mohammed.
I just received a message in the screen
Okay.
saying cloud storage is full, and then recording could be difficult or something. Is it something in my device or?
No. It's through Zoom. Give me 2 minutes. Let me just remove old one. Okay. And then after it will be record smoothly.
I'll tell you what, Jean, if you're able to save it in your hard disk or whatever, external hard disk, these videos, so that, anyone wants that can, ask you to submit it through WhatsApp maybe. So it can be done in this way.
Mr. Hatton, and what you have to do, you have to just download these recordings in your system. So you can save it as long as you want.
But yeah, I was having an issue in my let's say hard disk, but if because I didn't save anything.
One thing I will try to do. I actually gave these videos to my staff to download.
Okay.
So let me check whether they downloaded.
Sure.
Be with me.
You can record Mr. Muhammad now because I have.
He's recording now. It's recording.
Yeah.
Zoom lectures download பண்ணி சேவ் பண்ண சொன்னேன் செஞ்சோம் பண்ணி வச்சிருக்கீங்களா சரி எத்தனை வீடியோஸ் சொல்லுமா இல்ல ஜூம் இல்ல அதுல 5 இருக்குதா பத்து வீடியோஸ் இருக்குதா so what I'm hearing from my
try
staff.
to record the classes now. It can be done.
Pardon?
You please record the session now. You can easily record the classes.
Yeah, already the recording is on.
Okay. Thank you.
Yeah, my team is saying I will reconfirm that the recording they have downloaded. Just a minute, let me reconfirm. Bear with me, please. Video separate, right? Oh, okay. We have the videos.
Okay, great.
Hi, Sam. Actually, my team have recorded the videos. I mean, sorry, downloaded the videos.
Good.
And I will see how can I share with you.
There is only the only way, I think, through maybe a Google Drive or
yeah, that's exactly. I'm also thinking. I will get my guy to. What I will do, I will install in the cloud and I will share that access link.
Yeah. This is what I'm trying to say. Yeah.
That will be easy.
That will be easy. Absolutely.
Fine. Now, basic question: is screen visible?
Yes, it is.
Okay. Audible?
It's clear.
Alhamdulillah. Jayyid yani?
Sorry?
Jayyid wala mumtaz? Hello, Mr. Haitham.
Hello? Okay.
I ask you Jayyid wala mumtaz?
جيد جدا, in the middle.
Jayyid jiddan. Yes, Jayyid
Yeah.
jiddan. Yes, exactly.
Yeah.
Yeah. I am in between. I am learning Arabic. That's why I'm testing some words.
No, mashallah, you're doing good.
All right. So we will see. This is the topic we started, and then we talked about. No, I didn't actually go to the slide. I just went on to discuss about certain terminologies. The terminologies was IS8 continued 3rd February 2024. For your information, tomorrow is our Independence Day for Sri Lanka.
Oh, okay. So,
So
plans for that?
we need to hang the flags and then stand up and then salute and sing songs. Too many things. So,
Okay,
sir,
good.
yeah.
We're close, from our also flag, what do you call it? Foundation Day.
Exactly.
And in Saudi Arabia here as well. So
Yes.
in Feb,
Yes.
21st of Feb. Yeah.
And now we talked about certain terminologies. One terminology we talked about accounting concepts. We talked about that. And then another terminology we talked about accounting basis. And then another terminology we talked about accounting policies. Remember this? Yes or no?
Sorry, Mr. Muhammad, I wasn't able to see.
See,
I went.
okay. I have written these three terminologies.
You're not presenting anything, by the way.
I'm not presenting anything?
No. You're presenting
Oh.
your, okay. Now you're,
Screen visible now?
yeah, it is.
So can you read this?
Accounting concepts, accounting basis, accounting policies.
Very good. So you remember I discussed these three?
Policies, yes. Yeah, I'll try to recall.
You want me to refresh you?
Yeah, please.
Okay. What is actually accounting policies? Accounting policies is a collection of all this. Combination of accounting concepts put together with accounting basis that makes accounting policy. Understand me?
Yeah.
The good example was now when you talk about accounting concepts, you have many. Going concern, accruals, and so on. There are so many. I can keep on writing it. Correct? Prudent.
Yeah.
So this is the first step. So now when we think about accounting policies, we start with our accounting concepts. Then we have something called accounting basis. We have something called what?
Accounting basis.
Good example is
Okay.
method of calculating depreciation. I have two methods. Straight line method, reducing balance method. I'm sorry, Mr. Haitham, I will have to write the full form.
Mm-hmm. It's okay.
I forgot about you.
That's fine, no problem. These kind of
Ana inside.
terminologies, these kind of terminologies is just, repeated. I was,
Yes.
you know,
Straight line method, and then this one is reducing
balance.
balance method. I believe you know these two methods,
Yeah.
right? So now,
Yes.
what is accounting basis? Alternative accounting treatment available to deal with any particular accounting item. Alternative accounting treatment available to deal with any accounting item. Understand me?
Yes.
See, now my accounting item here is calculating depreciation. Correct?
Correct.
And what are the alternatives available?
Okay.
Reducing balance method or straight line method.
Okay.
So this is accounting basis.
I see.
Now then we talk about accounting policies. If you choose, for example, you decide to choose straight line method as your depreciation calculation, then straight line method will become an accounting policy for calculating depreciation in your company.
Okay.
Allahu Akbar, Allahu Akbar. So I hope you understood this now.
Yeah.
There is also something called accounting estimates. There is also something called what? Accounting
Accounting estimates.
estimates. Now this accounting estimates Example, let's say I have a car, motor vehicle. The cost is $80,000. Company decides, now is there any meter or is there any scientific meter to find out the lifetime of the vehicle?
No.
No. Who decides the life of the vehicle?
The management, I think, the accounting management, maybe they're going to.
Exactly. Management decides.
Yeah.
Based on what?
Based on the, let me say,
Based on their previous
experience.
experience and the knowledge.
Yeah, okay.
Yes or no?
Yes, yes.
So, is this legally mandated? Meaning,
legally
let's say you decide 4 years now, example. After some time, if you want to change it to 5 years, do you need to go to court?
No. It's
No need to
internal.
go to court, correct?
Yeah.
It's simply an accounting estimate.
But you have to, let me say, this will impact the, I think, impact the, I don't know, the other, what do you call it, the prior year adjustments, maybe? Or
I'm coming to that. I'm coming
okay.
to that only.
Yeah.
Okay? So, accounting estimates are managed judgmental. Give me a second. Huh? Yeah. So, it's a judgmental estimate.
Yeah.
Okay. So now there is two things. One is accounting policy. Other one is accounting estimate. Now this motor vehicle, let's say now I have now they are using straight line method. Okay, and they have decided 4 years, 2 years completed. Fine. So can you tell me what would be the total accumulated depreciation?
Straight line method will be okay. The what is the no price for the salvage?
No information. So you have to assume 0.
Okay, so in this case will be 80 divided by let me say 2 years or
80 divided by 2.
Yeah,
Estimated
I mean,
life is 4.
Yeah. So divided by 4.
Okay. And how many years finished?
2 years only. So times 3.
2 years. So what is my total accumulated depreciation then? No, for the sake of
40.
Convenience in calculation, allow me to change this.
Okay. $45K.
So how much will be the answer?
45,000.
Very good. Now management decides the total life is not 4 but 5. 1, 2, 3, 4. This is what they estimated up to year 2. They maintain this.
Mhm.
Then they say, no, we also, the vehicle has 1 more year. So they are changing what? They are changing the accounting estimate. Do you see that?
Yes.
So when they change the accounting estimate, what do you think the remaining life of the asset?
Okay. That will be the, let's see here.
Remaining life, how many years? 1,
Oh, yeah, 3 years.
2,
Okay.
3 years.
Mhm.
Isn't it?
Yes.
And also one more question. How much is the net book value here?
It was a 90 at book value.
Cost is 90
Yeah.
minus accumulated
Minus the
depreciation is
45.
45. So net book value will be
Okay.
45. You understand me?
Yeah.
Now, if you happen to change or revise your accounting estimate, what you do that to calculate the depreciation for year 4. I'm sorry, year 3. Depreciation for year 3. How will I calculate? I will not deal with this number. I will consider this
The
number
45.
as the new
Yes.
cost.
I see.
So 45, and I
Divided
need to
by
work out the
3 years.
remaining useful life.
3 years.
How many years?
Remaining 3 years, we said.
3 years. So what is your answer?
15K.
45,000 divided by 3?
15,000.
Very good. Now, you see, during this period, what is my depreciation per year?
It was 45.
The
What do you mean?
Mark
First you
45.
said,
Well,
okay.
90,000 divided by 4.
Okay.
Killasana each year.
See.
How much?
We said, okay. 22,500.
Very good. First year 1, 22,500. Year 2 also 22,500. For the remaining 3 years, every year you will have.
15,000.
Now, I will come to a word or point that you told me about, talking about some one word, one sentence you used. You use this word, correct?
Yeah. Yes. Which is in
For the
the
changes in accounting estimate,
other comprehensive income.
IAS 8
Yeah.
states that the changes in accounting estimate is not a change in accounting policy. You need to understand this.
Okay.
The changes in accounting estimates are not considered a change in accounting policy.
Clear.
Hello.
Yes, Mr. Zubair. Habibi, salam alaikum.
Yes, sir. Hi, sir. Sorry, salam. Sir, I am in a workshop. I am really sorry for repairing my car. I'm really sorry. I'm here to.
No problem.
Let's
Every single
come
story
late.
you will pay me 50 riyal.
No issue, sir.
So I will keep a
Sure.
register, and then every weekend I will send you a invoice with number of stories.
Okay, sir. Okay.
Fair no, Mr. Haitam.
Yeah, I'm also included. I gave you a good
Yeah,
reason.
you also included in that package. You know, I remember when we are in the schools in the English session, if we happen to speak a local language, each word we had to pay 2 rupees. And then the till, if this till will get accumulated month end, they will buy books to the classroom by that fines.
Oh, okay.
So likewise, we will penalize Mr. Zubair. So
maybe we can extend our Zoom capacity.
Yes, exactly. That's true. Yes.
Okay.
IAS states that changes in accounting estimate is not a change in accounting policy. Now, for changes in accounting So, for changes in accounting policies and changes in accounting estimates, the standard states the following, states below. But they say we need to do two different types of changes. Prospective changes, retrospective changes. So if you face changes in these scenarios, in accounting policies, yes, Mr. Zubair, you are talking to me? Yeah, both of you listening to me, right?
Yes, sir.
Yes, I can.
Fine. So for the two given changes, possible changes are either accounting estimate change or accounting policy change. For that, we need to do two different method of changes. One you call it prospective changes, other one you call it retrospective changes. Understand me?
Yes, clear.
Now we need to understand these two terms. What is prospective changes? The prospective changes, let's say 2020 2021, 2022. This is current year. Okay. Now, here you have made an accounting estimate change. You
In
change
future
accounting
period, it's
estimate.
prospective.
Pardon?
In future period, it's prospective, and last year it's been restorative.
You could say that. A little change is there, little different to what you told me. Now, what has happened? We have done an accounting estimate change in the year 2022. Okay? And it is standard said, if there is any accounting estimate change, you should follow prospective changes. So you have here, this is future year 2023. So what you need to do, you need to change in the current year. And all future years if applicable. Do you understand me what I'm saying?
Yes, clear.
Yeah. So meaning, if I do this, see this example I have written here, whatever estimate we have dealt with during these two periods, we don't need to worry when I am changing the remaining line on the next 3 years or 2 years or 5 years. So whatever happened in the past, kalas, that is nothing to do with us. My shape. Okay?
Okay.
And you will do the changes in the year in which we are working and any future years what is applicable to us.
And what about if there's a change in, let's say, the method itself, for example?
No, I'm coming to that. No, this is change in estimate.
Okay.
Change in estimate, you have to do prospective changes.
Okay.
But we also have something called accounting policies. Accounting policy, simple example, depreciation, method of depreciation. Depreciation, method of depreciation. The method of depreciation can be method of depreciation. We have example, straight line method, reducing balance method. Okay?
Yes.
Now, if I continue the same example, cost is 90,000. Okay? Useful economic lifetime is 5 years. Company currently following straight line method. So, depreciation for year 1, year 2, year 3. Can you please tell me how much?
Okay. Okay, 18,000.
Okay? Suppose if they are following reducing balance method, and if I say the rate of depreciation is 20%. Okay?
Okay.
And let's assume this is the current year. Year 3 is the current year, okay?
Okay.
Now can we calculate depreciation for the first year using reducing balance method? 90,000 into 20%. How much you get?
18,000.
18,000. This is year 1. What about year 2 now? How to calculate depreciation in year 2 using
18.
reducing balance method?
Okay.
19 minus 80.
90
Minus
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 18.
8. Then 20%.
Yes. How much is that?
14,400.
So can we take the total of these two?
Okay. Plus 18. 32,000. Okay. Okay. 400. Yes.
32,400. This is what method? Reducing balance
Balance.
method. But if I will follow straight line method, end of year 2, how much is the total?
End of year 2.
Depreciation total.
Depreciation total 36,000.
36,000. As we know, the method of depreciation is one example of accounting policy. Method of depreciation is one example of accounting
This policy.
policy. Accounting policy will impact to that particular accounting item since the inception. All accounting policy will impact the accounting item since the inception. Do you understand?
Yes, clear.
So what then we need to do? Straight line method, reducing balance method. 36,000, 32,000.
400.
So had I used reducing balance method instead straight line method, how much I will save?
3,600.
By this number, you see here, on this year, that is my current year, or actually on the opening date, on year 3 opening date, what is my impact to my profitability? What is my impact? Impact on the profitability is what?
You're talking about the second year or the third year? Sorry.
No, sir. I'm talking about the total of the 2 years. If you use straight line method, your total depreciation will be 36,000.
Yes.
But if you use reducing balance method, your total depreciation is going to be 32,400 at the end of the second year.
Okay.
Now we are in the verge of starting the third year.
Okay.
So on the beginning of the third year, what is my impact to the profitability because of the change that we have carried out in the third year?
Reduce. It's going to be there will be a reduce in the profitability or
Profit
reduction
will reduce or profit will increase?
because we were 36,000 and
See. The old method is this.
okay.
New method is this.
Okay,
So
there will be
from
increase in profitability. Yes,
there will dip, there will be what? Increase or decrease?
no, increase because we're going to expense this, in our books.
The profitability should increase.
Yeah.
Correct? Now the problem, you
Yes.
see, there is a problem we will face. What is the problem? Problem is year 1 and year 2 financial statement already published or not yet?
I didn't hear you well. Just can you repeat, please?
But I'm saying the financial statement for year 1 and year 2
Okay.
during year 3, has it been already published or not?
No, still not published.
Habibi, at least year 1.
Okay, year 1 is published and year 2 published. That's because we.
Yeah, that's what I'm saying. Let's assume both the years already published. We'll assume
Okay.
like this. Can I go back to year 1 or year 2 and do a change to this
No.
impact to my profitability?
No.
I can't do that. So then this we need to change in the current year. Change of the impact to the profitability should be adjusted in the current year. Agreed or disagreed?
Agree.
Fine. Now, in our, if you see your statement of financial position, in short we call it balance sheet, there is one particular area called equity. There is one particular area called equity. Yeah. So there is a particular section called equity. This equity will have share capital, return earning, and that total is my equity. Correct?
Correct.
There could be others like general reserve or evaluation reserve. We will not discuss about that. Now, if I tell you like this, will you agree with me? This return earning is like a pot. The pot carry forward all our remainders from the previous year. Yes or no?
Yes.
Now, the impact to my depreciation because of the old method, this already within this equity or not?
An equity.
Yeah, meaning in return earnings, in equity but in return earnings.
Yes.
So, what we need to do is, we need to go and do a change to my retained earnings.
Yeah, correct.
If you see the format of the statement of changes in equity, I have capital, I have return earnings, and I have total. And I have brought forward, and as I told you, this opening balance coming from the previous year's accumulation.
Okay.
So now we understood this particular amount needed to be adjusted. So if you followed reducing balance method from the very inception, what would have happened to your profits? Instead of using straight line method, had you used reducing balance method from the inception, your profits would have
reduced.
increased,
Increase.
increased by.
3,600.
So don't we need to adjust that here?
Yeah.
Yes or no?
Yes, yes.
That adjustment, as you named it, prior year adjustment. Faham, Mr. Haitham?
Clear.
Mr. Zubair?
Yes, sir.
Good. So, this type of adjustment, in other words, we have something called retrospective changes. Understand me?
Yes.
Okay. This we talked about accounting policies and accounting estimate. We also need to discuss about errors. Errors, I told you there are two types of errors. Fundamental errors and nominal
Errors.
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 And I hope we discussed what are fundamental errors.
Yes.
So, fundamental errors and nominal errors. Now we discussed what are fundamental errors. If the entity has fundamental errors, then should see example that the storekeeper stealing the rice bag, and if he does not only in 2023, he does this in 22, 21, and 20. You uncovered that the fraud is taking place for the last 3 years. Okay.
Yes, clear.
In that case, you have to go and adjust the profit or the return earnings related to previous years as well. Correct?
Correct.
So, then should be changed or corrected. Sometimes they use the word rectified on a retrospective manner. Get me? So if I have share capital, return earnings, and total, and I have brought forward, and we now found some errors relating to the previous years. So, correction of errors, PYA. What do you think PYA is?
Prior years adjustment.
Very good. Now Mr. Haitham is learning to use the abbreviation.
Yeah.
Yeah.
So, that So this will be another prior year adjustment. That will be retrospective changes. Correct?
Yes, correct.
Now, then we can take the net total. And with other entries like profit for the year, dividends. So statement of changes in equity can have many other entry items which we are not worried about. Okay?
Okay.
So, fine. So we have discussed accounting estimate, accounting policies, and changes in errors, and we talked about prospective changes and retrospective changes. Understand me?
Yes.
Yeah.
I will take a small break and I will continue.
Okay.
Okay.
Hello. Who is it? Is the Zubair gone?
Yeah, looks like.
Mr. Haitham?
Yes, I'm with you.
Yeah. Mr. Zubair gone? Or
Yes.
we will text him in the group. I actually doing another series of IFRS with a team, and then I'm sharing those videos in YouTube. I would kindly request you to watch them.
Okay.
And one video I have shared in the group as well.
Sure.
Fine, now say we will now go to the slides. Accounting policies, changes in accounting estimates and errors. This standard was applied to annual periods began almost immediately after 1st January 2005. That is the effective date of IAS 8. What are the objectives? Selection of accounting policies, changes in accounting policies, accounting treatment, disclosure of changes in accounting policies, changes in accounting estimates, and correction of errors. So these what we will discuss in this standard. Relevance and reliability of financial statements. Now these are coming from where? The relevance and reliability is coming from the fundamental qualitative characteristics of financial statement. Remember that?
Mm-hmm.
And also, you see one more point here. Now, this is 2023 and this is 2022. Now, I am having depreciation. In 23, I am following reducing balance method, and in 21, I am following 22, I am following straight line method. Is this comparable?
No, I mean, no, because the
Yeah,
policy
this
is
will not be
changed.
comparable. So what we need to do, yeah, we then have to go back to 22 and restate the financial statement. There is something called restating the financial statement. How? Statement of changes in equity and prior year adjustment. Understand me?
Yes.
Yeah. So, comparability of financial statement with the financial statement of other entities and of prior periods of the same. That we need to confirm. That these should be comparable in within the same year with other entities, with the same entity with prior years. Retrospective application is applying a new policy to transactions, other events, conditions as if that policy had always been applicable. Now we don't need this. Here I will put S. Had always been applicable. Now this is if you have a change in accounting policy and you will change it, that you call it retrospective application.
Okay.
Whereas retrospective restatement is basically the after effect of retrospective application. After you go and change those numbers and for the years related to the prior periods presented along with the current year financial statement. Clear?
Yes, clear.
Is it matching with what we discussed so far?
Yes.
Prospective application means applying the changes on current and future periods only. In the past, what's done is done no such alteration is required in the books of accounts. What they're saying is, so year 1, year 2, year 3, year 4. We are doing change in the year 4. So you don't need to go back to the previous period to do the changes. You understand me?
Yes.
And also there is something called applying a change is applicable only to the extent of practicability. Or if it is not practicable, then you don't need to do it. Applying a requirement is impracticable. When the entity cannot apply it, see, this is statement very interesting. After making every possible effort, I will add one more word, to do so. To do so. You understand it?
Yes.
So, I discussed this. Basis, rules, conventions. Conventions are policies. I mean, not policies, principles or concepts. Practices, specific principles. So these all collection of all these becomes that are applied in preparing and presenting financial statements. Reasons for changes in accounting policy. Normally, accounting policies should not change. Normally, you cannot change your accounting policies. But you could do it in two circumstances. What are those two circumstances? When another standard needs such changes. Understanding?
Yeah.
When another standard needs such changes. Second one, the regulation applied locally demands a change. Third one, for a better, true, and fair way. Understand?
Yes.
So these are the three circumstances in which you are compelled to change your accounting policy. What is retrospective? When a change in accounting policy is applied retrospectively, the entity shall adjust the opening balances of each affected component of equity for the earliest period presented. That's very important. What do you mean by this? See, if you have a financial statement for 2023 and the history of that running into 2012, and this is the first time they have started presenting an item that has changed in 23. So your changes or your correction should go up to which year? What do you think?
Mm. Hello?
Hmm?
Hello?
Now what I'm saying is, you start the business in 2012. Okay?
Okay.
Now we are in 2023.
Okay.
Oh, and we were following one particular accounting policy all these years. And suddenly we found the currently applicable accounting policy is not good. And you changing it. So your previous changes should go to the extent of which year?
Full start from 24. I mean,
Habibi, 2024 is next year, Habibi.
yeah, okay. So there's,
So what I'm saying is, you start your business in 2012.
okay.
You were following one particular accounting policy for some item from 2012.
Okay.
Now you continue doing business and you reach to 2023.
Mm-hmm.
Now you suddenly found the currently following accounting policy is not applicable or not correct. Then what you do? You got to revise it, you got to change it. So are you only going to change it in 2023 or you gonna go back to previous years?
Oh, 2023 will through the prior year adjustment as well.
Yeah, but this prior adjustment calculation will lead to which year?
23.
Yes, yes, you will do it in 23. Okay, but my
Okay.
question now, I mean, if you look into this example,
Uh-huh.
yeah, this one. Now, first 2 years your depreciation is 22,500, correct?
Yes.
In the third year, no, I'm sorry, I used a different example. Example is down below here. This one. Now, first 2 years you calculated depreciation using straight line method, correct?
Okay.
Or first 3 years, in other words, first 2 years or 3 years. So year 1, 18, year 2 also 18, in the year 3 also 18. But now you suddenly decide to change the depreciation calculation percentage to 20%.
Mm-hmm.
So then what happens? Your depreciation for 2 years. If you look into this 2 years, there is a change of how much? 3,600,
600.
correct? So this
Yes.
3,600 relates to how many years?
2 years only.
Correct. Meaning the previous 3 years. Yes or no?
Yeah. Yes.
So what the standard is telling, you need to go to previous year. To which extent? That's the question. Until the earliest financial statement is available with you.
Okay.
Sometimes your business may be 15 years. 7 years financial statement you already scrapped.
Uh-huh.
Then what you
Okay.
will do? You only need to do the 8 years adjustment.
I see.
So that is exactly what I'm trying to tell here.
Okay.
See, so we are in which year now?
23.
We are in 23. But this particular adjustment relates to which year?
8 years before. Or, said.
2012, correct?
Yes, 2012.
So you got to go back to 2012. I will write the statement here. What they are saying is earlier presented financial statement. So you got to go and check which year the first financial statement is available.
Okay.
Clear?
Yes, clear.
Now I will bring one more small complication now. You start the business in 2012. Business commenced 2012. Earliest financial statement available is 2023. 16. So now today is 2023. So you should go to which, to the extent of which year now?
16.
Very good. You should go to the extent of 2016, not to 2012. This is the point I wanted to emphasize.
Okay.
Is that clear?
Yes, yes.
Very good. And the other comparative amounts disclosed for each prior period presented as if the new accounting policy had always been applied. See? Does that make sense?
Yes.
Good. But it's impracticable. When it is impracticable to determine the cumulative effect at the beginning of the current period of applying a new accounting policy to all prior periods, the entity shall adjust the comparative information to apply the new accounting policy prospectively from the earliest date practicable. What they say. In case, you see, I am in 2023, so we have comparative 2022, and then we may also have previous financial statements. But now I am here, and I am unable to go beyond 2012. I can only go to the last year. So what must I do? I should limit my changes only to these 2 years.
Okay.
If another situation, if you are even unable to go to 2022, you are limited only with 2023, then should follow prospective basis if previous information not
Available.
available. Is that clear?
Yes.
Disclosure requirements of change and change in accounting policies. Nature of change, description of transitional provision, if any, for the current period and each prior period presented to the next practicable, the amount of adjustment, any adjustment that you need to disclose. For each financial statement, line item affected, and you should amend EPS. What is EPS now?
Yes.
EPS means earnings per share.
Okay.
So we will talk about earnings per share in a different standard. And for your simple explanation, in your profit and loss account, the bottom line, final answer, we call it profit for the year. Okay?
Okay.
And what is EPS? Is equal to profit for the year divided by number of years.
Yes.
But please remember, don't blame me later. When I write profit for the year, they have more additional clarification. And also when I write here, again more additional clarification. I'm not here to discuss and complicate you more. So I'm not doing that.
Okay.
Okay?
Yeah, it's
So,
clear. It's clear.
must both. Change in accounting estimate is an adjustment in carrying value of an asset of cost or a liability or the amount of periodic consumption of an asset as a result of present conditions and circumstances. Good example is depreciation percentage. What are the reasons for estimation? When an item of financial statement cannot be measured precisely, it can only be estimated. Because uncertainty is inherent in the business. What do you mean by uncertainty? Uncertainty. What is uncertainty? How many of you remember reading news from meteorology department? Meteorology. I think my spelling is wrong.
Uncertain. Something is not in a
Clear or not,
proper way.
Stable.
Stability.
Stable.
Pardon?
Uncertainty is something not stable.
Okay, but no. Do you know what is meteorology department or don't know?
I couldn't
No.
hear you.
You cannot hear me? Can you
No,
hear
I
me
couldn't
now?
hear you. Yes, I can hear you now.
1 second, 1 second. Can you hear me now?
Yes, much better.
Okay. So do you know what is meteorology department?
No.
Habibi. Show Fadi.
Meteorology department.
Weather forecast. Meteorology.
Your voice is not clear, Mr. Muhammad.
Yes, Mr. Zubair, you are saying something. Hello.
Your voice is not clear. Your voice is not clear.
My voice is not clear? Okay, I think I know the reason. Wait. Yeah, let me change. The internet. Hello.
Yes, we can hear you well.
You can hear me well, Mr. Zubair?
Yes.
Yes, sir. Yeah.
Good. Okay. Can we go back to my example? Do you know what is meteorology department?
We called it here the General Authority of Meteorology and Environment Protection.
What's their job? What is their normal job is?
Prediction.
Checking the weather forecast.
Forecasting.
Predict
the weather, or
predict
the weather.
Yeah.
Now the question is, how accurate their predictions are?
In Saudi, I can say 70 to 60.
Let's not bring Saudi into equation. Let's talk about our countries like Sri Lanka or India. See,
here in Saudi, they're sending message through SMS, okay? That we predict, there will be, let's say a rain or something like that. But you'll discover at the end that there's nothing,
that's exactly what I want to. The point that I want to emphasize is that
the point is that they want to send you the message. Okay,
You will see the news, in the TV news, you will see like this. Tomorrow there could be rain or could not be rain.
Yeah.
Remember hearing this statement?
Okay.
Okay. I'll give you another example. Let's say you have a house. And this is known as parapet wall. Many villas and compounds have their own parapet walls. Yes or no?
Yeah.
Sometimes this fellow, what do you think? Who is this fellow? Without time naming, can you guess?
Cat, it's very clear.
No, masala. See, I can go to art competition.
Yes. You draw very good.
So the cat is sitting on the top of the wall. Can you give me a written paper? Cat is going to jump inside the house.
No.
No one can do that, correct?
Yes, I can do that. Yeah.
This is what the uncertainty means.
Okay.
So, prediction, future. The outcome of future is not within the control of us today. That is what the uncertainty is. So, why should we do estimate? In order to mitigate the uncertainty, correct?
Correct.
And also, where judgments are needed. So this is pardon?
Can you hear me?
Yeah, I can hear you.
Yeah.
Okay.
Mr. Zubair, you can hear me, right?
Yes, sir, yes.
Yes, good. So, where judgments are involved. Correct? So, where estimation is required. Following examples. What is bad debt? Do you all know or you don't know?
Yes.
We see the new term for bad debts are irrecoverable debts. Okay?
Yeah, I know, but yeah.
Inventory obsolescence. What is inventory obsolescence? So know or you don't know? Hmm?
Hello.
Yeah. What is inventory obsolescence? I'm waiting for someone to respond.
Hello.
Hello? Hello?
Yes, I can hear you.
You cannot hear me?
No, I can hear you now.
Can you hear me now?
Yes, I can hear you now.
Okay. What is inventory obsolescence?
Not clear to me.
My voice is not clear or the term is not clear?
No, the term is not clear.
Okay, that's not a problem. We will make it clear. Inventory Obsolescence. The spelling. Yeah. Inventory obsolescence. Now, Mr. Haitham, you are into which trade? Your company?
Sorry?
What is your trade? Your company, what is they are into which industry?
Financing.
Financing?
Yeah.
Okay, Mr. Subair,
Yes, sir.
what industry your business is, your company?
They have electronics branches.
He is much close to this terminology than me.
Yes. So when you say electronics branches, you have inventory or you don't have?
Yes, we have.
Okay. When you have inventory, do you experience have outdated, old-fashioned type of inventories?
Yeah. Because it's
So
an
this
asset.
old-fashioned, outdated type of inventory is known as what? Obsolete.
Obsolete. Okay. Yeah.
Which is
Obsolete
old.
items. Mr. Haitham.
Not
Yes.
running item. Not running item.
Yeah,
Yeah.
old, or old items. That's what he's trying to say.
Think about this R&D or red tag. These outlets.
Yeah.
Sometimes what happens, they go for promotion.
Correct.
Buy 2, get 1 for free. You remember seeing this slogan?
Yeah.
So this is what they really do is that when they are planning to bring the new item, in order to reduce the chance of the old item getting stocked or accumulated, they go for this type of promotion.
Yeah, usually they take it to outlets,
Yes.
low cost.
So I hope you understood now what is inventory obsolescence.
Yes.
Okay. The fair value of financial assets or financial liabilities. I hope you know what it is. We need to estimate the fair value of financial assets or financial liabilities. Correct?
Yeah.
And useful life or expected pattern of consumption of the future economic benefits embodied in depreciable assets. So the depreciation also an estimate. And also warranty obligations. So this is clear, right?
Yes, clear.
Okay. When change in accounting estimate becomes necessary, when should we need to do a change to our accounting estimate?
Yes, sir.
Changes occur in the circumstances on which the estimate was based as a result of new information, as a result of new development, or more different experience. You remember we talked about judgment and experience. And they come up with the depreciation life of the asset based on experience. If they have no experience, then what they will do, they will change it. So these are the reasons why we should require a change in accounting estimate.
Yeah.
So, what is the recognition criteria for change in account? We discussed already. Adjusting the carrying amount of the related assets or liability or equity item in the period of change recognized, a change in an accounting estimate. So only in the current year, period of change. Remember? So this one example is here. Management estimated that provision for doubtful debts up to 5% of the total population of the trade debts. However, upon identifying the age of the trade debts, it revealed that bad debts are about 6.5%. Now you see what happened. Before it is 5%. And this is simply an estimate. Now it is how much? So this is new estimate. So what we should do, this should be considered a change in accounting estimate. Change in accounting estimate. So understood this particular slide? Clear, no?
Yes, clear, yeah.
Yeah, accounting treatment of changes in accounting is International Accounting Standard 8 requires recognizing the effect of the change in accounting estimate in the current year. You remember I discussed this. And future periods affected by the change. I have written here in my notes, if applicable. You remember this, right?
Yes.
So I'm proceeding. Disclosure required for change in accounting estimate. If the effect of change in estimate is immaterial, if it is not big, as usually the case for changes in reserves and relevance, you do not require to disclose anything. However, we disclose the change in estimate if the amount is material. Also, if the change affects the several future periods, that's what I discussed here. I told you current year and any future years. Remember that? See here?
Yeah. We remember that.
And you also need to disclose the effect on income from continuing operations. So we will talk what is continuing operation in a different standard. Don't worry about that. Net income and also earnings per share. Errors are mistakes by literal meaning. They can be classified as shown. Errors related to prior reporting period. Errors related to current reporting period. So what happens if it is prior related to reporting period? Then we need to do it retrospective change. Correct?
Yes.
This is nominal error. Current reporting period. Prospective changes. Right?
Yeah.
I have seen, before I opened up the slides, I gave you the very detailed explanation as to this topic. Correct? Just that I am reading the slides, and if you don't understand anything, feel free to raise questions.
Okay, yeah.
So, what are prior period errors? Future failure to use or misuse of reliable information that was available when financial statement for those periods were authorized. Good example of that is fundamental errors. See the way they have used the word here, failure to use or misuse of reliable information that was available when financial statements for those periods were authorized to issue. What happened? Accountants kept quiet. They didn't publicize such information, and they published the financial statement already with having the errors. Failure to use or misuse of reliable information that could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements.
Clear.
So, what are examples of prior period error? Effect of mathematical mistakes, mistakes in applying accounting policies oversight, misinterpretation of facts, and fraud. I talked about, mainly I discussed these two. Clear?
Yeah. Yeah, clear.
Yeah.
Yeah.
What is the treatment for rectification of errors? An entity shall correct material prior period errors, see, retrospectively in the first set of financial statements authorized for issue after they are discovered by restating the comparative amounts for the prior periods presented in which the error occurred. In simple, you just remember what I explained you in the notes. Here, you remember what I explained, you know?
Yeah.
So, I'm just sake of formality, I'm reading this. This will give you a complete note, that's all. If the error occurred before the earliest prior period presented, restating the opening balances of assets, liabilities, and equity for the, see, again, they are using the word
And
earlier prior period presented. Clear?
Yes, clear.
What are the disclosure requirements for IAS 8? Nature of the prior period errors. To the extent practicable, the amount of correction for each financial statement line item affected and division of EPS. See, this is a different standard, IAS 33. I don't know, this is part of the syllabus. If it is part of the syllabus, I will discuss. The amount of the correction at the beginning of the earliest prior period presented. How much you have corrected in the beginning. If retrospective restatement is impracticable for a particular prior period, the circumstances that led to the existence of the condition and the description of how and from when the errors have been corrected. Meaning, let's say, now we are in 2023, you cannot go and correct the 22 for some reason. Then what you need to is disclose how you corrected in 23. Understand me?
Yeah.
Good. And this concludes the discussion of IAS 8. Now we can move on to a question. I will take 2 minutes break and then I will continue. Okay?
Okay, okay.
Sure, sure.
Zubair?
Hello guys. Shall we do question now?
I'm with you, something that.
Yeah. We will discuss
no.
questions.
Yeah, but
Yeah.
you wanna? Okay.
You already have IAS 8 slides with you?
Sorry, sir?
No, what I'm saying, the PowerPoint presentation I already shared it. So, okay?
Yeah,
Yeah, that was check.
it is there.
Okay, I'm going to share the question. The screen is visible?
Yes.
Okay, then we can start the questions.
On your screen, not yet, but let me.
In my screen, no?
No, I can't see it. Just a
No,
second. Let me.
Alhamdulillah.
No, still
Change in method.
Shafto?
not yet. We are still trying to. You're still trying to open. Okay, I can see the main screen. Okay.
Can you see this now?
Yes, yes. Now it's open.
Okay. Which of the following is not considered a change in accounting estimate?
I think E is the answer.
Okay.
What is the answer?
No, live. The first one is we excluded. First one excluded.
Which one in the estimated useful life? That is a change in accounting estimate, correct?
Not considered a change in accounting estimate. The first one is
Yeah, question is,
excluded.
which one of the following is not considered a change in accounting estimate?
Yes, yes.
So what do you think the most appropriate answer?
B.
I will like to add one more sentence to option B.
Mhm.
When you read this, a change in the method of depreciation, can you add one
Yes.
sentence there? Percentage.
Depreciation percentage.
B.
No, which
Yeah.
Okay.
okay.
Now, what is the most appropriate answer?
Okay. Correction of an error made in the trial. Okay, the first one we can exclude it because as we said that if we changed it,
I think B
nothing will.
is the right answer.
No, B percentage. Depreciation percentage.
Okay.
That is wrong.
Percentage.
So
Yeah.
I add here percentage.
Yeah, which
So
is
when I
nothing.
add here percentage, that also
Excluded.
becomes,
Excluded.
that also need to be excluded, correct?
Yes, 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 yes. We'll say, a correction of of an error made in a prior era.
That is not an estimate, correct?
Yes,
So this is the
Yes,
answer.
we can.
yes.
Next.
How should the change, in accounting estimate be accounted for?
How should the change in accounting estimate be accounted?
Retrospectively.
That is also correct. And C, what do you think about the option C?
In the period of change and future period of effect.
This is, in other words,
Yes, yes, yes. This is correct. Respectively.
okay? Question 3.
Which of these?
Changing from FIFO to weighted average. Adapting accounting standard.
This is very easy, straightforward.
Yeah, C.
B.
C.
Uh,
Huh?
yes, yes. C.
B.
Oh, wait.
B or BB or Habibi or what?
Changing the method of
Adapting new accounting
B.
standard
yes,
required by
yes,
this is not an accounting policy, okay?
yes,
Yeah.
Understood?
yes, yes.
Yeah.
Do I need to go through other answers or can I go to the next question?
Yeah.
You can go to the next question.
Great. Next question.
And I said, how should material error in the
If the material errors, what should we do?
I just
By
understood.
making a prospective adjustment in the current period, wrong. By
Wrong.
disclosing the error in the
Wrong.
footnotes, wrong.
B.
Mashallah, B. Question number 5. Which of the following is not a change in accounting estimate? Reassessment of provision for warranty is an estimate. Changes in expected useful life of depreciable assets, estimate.
Yes, it is.
Changes in the method of inventory valuation,
It's estimate
estimate.
as well. Yeah.
So answer is,
estimate.
what is the treatment for errors discovered in prior periods under IAS 8? If I read, they should be corrected by adjusting the opening balance of retained earnings. I will leave that, I will pause it. They should be corrected prospectively, no. They should be disclosed in the notes of no. Now it's between A and C.
It should be.
They should be restated in the financial statement for the prior periods. That is the correct answer.
Yes, this is the correct answer. Yeah. Which of the following?
Which of the following statements regarding accounting estimates is true under IAS 8?
Change in estimate and its materiality when change in estimate.
See, they are saying inherently inaccurate. Is that correct? Estimates need not to be inaccurate. Yeah? So that is wrong. Accounting estimates should not be revised if they differ from actual results. No, it should be revised. The uncertainty inherent in accounting estimates may result in the need for revision in subsequent period. That's the correct answer.
Correct.
When should changes in accounting estimates be recognized under IAS 8?
Materiality.
Accounting estimates. When there is a change in estimate irrespectively of no, that's wrong. When there is a change in estimate that is considered immaterial, that's wrong. When there is a change in estimate that is considered,
this is the correct.
Material.
Yeah. How should the change in accounting policy that is applied retrospectively be accounted for? By adjusting the opening balance of retained earnings for the earliest period presented.
This is
So that is the answer.
A. Yes, A.
And the last one, under IAS 8, what is primary criterion for selecting accounting policies? Nothing to do with regulatory requirements, nothing to do with industry norms, nothing to do with management preference. It's about
Comparability and
comparability and relevance. So with that, we are done with the questions. And I need to attend for another meeting. I may have to stop the lecture now. We will meet tomorrow.
Inshallah. Okay.
Okay. Thank you so much.
Thank you.
And I'll see you tomorrow, inshallah. 6:30.
Inshallah. Yeah, inshallah. Mr. Muhammad, any update for my registration resume?
Oh, I actually forgot to ask. Give me time until tomorrow. I will, before 3 p.m. tomorrow, I will text you.
Okay, sir. Okay. Thank you, sir. Thank you. Thank you. Thank you, sir.
Please give me time until tomorrow 3 p.m. Okay?
Okay, sir.